When you deposit money in a bank, most people imagine something very simple. You walk in, hand over your cash, and somewhere deep inside the building, a vault door closes behind it. Your money just sits there, safe, waiting for you to come back. But the truth is much stranger, because the moment you deposit that money, it doesn't stay still. It starts moving. In fact, within minutes, your deposit may already be doing something completely different than what you think. Stay with me until the end. Hit the subscribe, and I promise you, you will understand where does your money actually go after you deposit it. Part 1. The liquidity illusion. Banks are built on something economists call liquidity. Liquidity simply means this: how easily money can be accessed. When you open your banking app, you see your balance: $1,000, $5,000, $10,000. And it feels like that money is just waiting there for you. But here's the strange part. The bank is showing you a number, not a physical pile of cash. Your account balance is a promise that the bank can give you that money when you ask for it. But here's where things start to get interesting, because banks don't actually keep all deposited money sitting still. That would be extremely inefficient. Imagine if every dollar deposited in a bank simply stayed locked in a vault. Banks wouldn't make money, loans wouldn't exist, businesses couldn't expand. The entire financial system would slow down dramatically. So instead, banks do something different. They put that money to work. Part 2. What banks actually do with deposits. Let's say you deposit $1,000 into your bank account. You might assume the bank now holds $1,000 for you. But in reality, that money quickly becomes part of a much larger pool. Banks combined thousands, sometimes millions of deposits together, and that pool of money gets used for several things. The biggest one? Loans. Your deposited money may help fund someone's mortgage, a car loan, a student loan, a business expansion, or even a credit card balance. Your deposit becomes part of the money that allows the bank to lend. But banks don't lend every single dollar they receive. They keep a portion available. This portion acts like a buffer, a cushion, because banks know something very important about human behavior. Not everyone withdraws their money at the same time. Most people leave their money sitting in accounts for weeks, months, sometimes years. So banks carefully balance two things: money that stays available and money that gets loaned out. This system is called fractional banking, and it's been the backbone of modern finance for centuries. Part 3. Why withdrawals depend on timing. Here's where timing becomes critical, because when you withdraw money, the bank doesn't necessarily hand you the exact same bills you deposited. Instead, the bank fulfills its promise using the available liquidity it currently has. Your withdrawal is paid using money circulating through the bank at that moment. Sometimes that comes from new deposits, loan repayments, or reserves held by the bank. This works smoothly because withdrawals usually happen gradually. One person withdraws a little, another deposits money, someone else pays back a loan. The system is constantly moving, money flowing in, money flowing out, like water circulating through pipes. As long as the flow remains balanced, everything works perfectly. Part 4. Why the system works. The entire banking system depends on one simple assumption. Not everyone will ask for their money at the same time. And historically, that assumption has almost always been true. People withdraw money when they need it, but millions of people rarely empty their accounts all at once. That steady rhythm is what allows banks to operate. Deposits come in, loans go out. Money circulates through the economy. And from the outside, it all looks effortless. But underneath, it's a carefully balanced system built on trust. So the next time you deposit money,
Remember this: your money doesn't just sit in a vault. It becomes part of a constantly moving system, a system that powers loans, businesses, and entire economies. And if that sounds surprising, wait until you see what happens next. Because in the next video, we'll explore something even stranger: how one single dollar can be loaned multiple times. After all, we're just asking, aren't we?